Candlestick charts are a straightforward way for traders to interpret share price action, as they highlight the direction of price movement, opening and closing prices, and price highs and lows. Astute traders use candlestick charts to study the psychology of market participants. Good afternoon, everybody. Welcome. My name is Sean van den Berg. Welcome to our session today. As you can see, the title is Candlesticks Will Not Leave You in the Dark. I'm an investment specialist here at PSG Wealth. My objective today is to discuss how candlestick charts provide an extra layer of analysis on top of the fundamental analysis that forms the basis of trading decisions. So this is my agenda for today. Just very briefly, we're going to discuss four main things. If I can just move to the next slide. Okay, as a quick intro, I want to talk about line and bar charts as basic share price charts, and then obviously spending most of the time on the introduction to candlesticks, and I'm going to spend most of the time on that section. The introduction to candlesticks, I call it the anatomy or the elements that makes up a candlesticks, and then we're discussing 5 bullish candles and 5 bearish candles. But my objective today is, as the title entails, is to shed light on candlesticks. So this is a quick introduction to price charts, and this forms the foundation leading up to candlesticks. We're going to discuss what is a line chart and what is a bar chart. So first things first, let's look at a line chart. Now, the most basic price chart is the line chart, because it represents only the closing prices over a set period of time. So this here is a chart of Anglo Industries, AVI. It's two-dimensional. You can see on the horizontal axis, that refers to time. So we're going right back to November last year. So it's roughly about a year. And then on your vertical axis, we've got price. So price is always in cents. So it's 95 Rand 60 to as high as 122 Rand 51. Okay. So the closing line is formed by connecting the closing prices over the time frame. So in this situation here, I'm using a daily chart of Anglo Industries going back for the last year as such. Okay, so the line charts do not provide visual information of the trading range for the individual points, such as the high, the low, and opening prices. Okay. However, the closing price is often considered to be the most important price in the share data, obviously the data you get from the JSE every day, compared to the high and the low for the day. So this is why the closing price is the only value used in line charts. Okay, so I use all three charts. Okay, I use a bit more, but these are the three basic charts I use. These are the easiest way to pick up chart patterns like head and shoulders and double bottoms and things like that. You can see very loosely that's your left shoulder. You draw a line here. If I bring my little cursor in here quickly, my pen. If I draw a line in there, sorry, that's supposed to connect the two lows. That'll be your left shoulder, your head and right shoulder. You measure that distance, and on the breakout, you can exactly the same distance. You see, basically went to that same level. So that'll be what I call a head and shoulders. This is a double bottom. You can see the W looks like a big wimpy sign. But as I say, the line charts is the easiest way to pick up the chart patterns, these kind of chart patterns. Okay, let me just go back to my cursor. Move back to normal. Okay, so that is a closing line chart. The very basics, but very important to use. We go up one level from there. Same chart again, same company, and you're looking at Anglo Industries, but in what they call a bar chart. So the bar chart expands on the closing line chart by adding several more key pieces of information to each data point. So the chart is made up of a series of vertical lines or bars that represents each data point. So you can see I've zoomed in a bit more. So you can it shows you from July till November. Oops, let me just get rid of these things here. That's not supposed to be there. Erase drawings. Okay. So I don't know if you guys can see it, but what's important here is that the vertical line represents the high. Oops, sorry, let me go back. Represents the high for the day, okay, and the low. Okay, so you can see that trading range. So if you guys can see it, it'll tick to the left to be the opening price, tick to the right to be the closing price. Okay. So what's important to understand here is that bar charts also show a bit more information, what we call gaps. You guys can see it here. That's a gap you would have seen on a line chart. So that is a bit of panic selling. This is a gap there also. When you saw just now the double bottom, that's the close of that double bottom. Sorry, there's the close of the double bottom, and there's the other close there that made the double bottom. But you can see the range was a bit more. The sellers were trying to push the price a bit lower. Okay. So again, I'm just building up on the line chart. Bar charts give you a bit more information, especially with the range. Okay. So let's build up to the big thing now. We're talking about candlestick charts. So the idea here today, they say that you do not need anything else on a share chart but the candles themselves to be a successful trader. And that is my personal view on technical analysis. I look at price action, especially candlesticks. Price action is my number one primary indicator, and everything else will be secondary. Okay, so candlestick charts show a combination of obviously the open, the high, the close data in a format that easily shows up and down days at a glance, and that's what's important. At a glance, I can see where's the momentum going, who's winning the fight between the buyers and the sellers. Okay, and that's exactly why I like candlesticks, because it shows the market psychology. Okay, so it just takes the bar charts up another level. So what I mean by a market psychology, there are only two groups of people in the market. There are buyers and sellers. We want to find out which group is in control of the price action right now. In other words, who is winning? And that's where the psychology comes in. We can look at a glance by looking at candlestick charts, and I'll go into more detail in the next few slides, and you can see who's winning this little tug of war. So we use candlestick charts to figure that out. So how do you study candlestick charts? And this is the bad news. Unfortunately, you have to practice reading these charts. How do you do that? Those of you that don't have access to our platform as such, I suggest that you open up a demo account, because on our demo account, you'll have access to our research platform. And on our research platform, you'll find share info. And there is a free web-based charting platform program that will help you plot candlestick charts as a starting point. Okay. So what's important now, let's look at the same example again of AVI. This is looking at candlestick charts. You can see there's a bit more color in now. So I've colored the down days red, and blue, and the up days as blue. So just at a quick glance, I can see compared to the previous day who's winning the little battle. But in the share market, for every buyer, there has to be a seller, and for every seller, there has to be a buyer. That's how we make transactions in the market. If the share closes at the top of the range, that means that the buyers were more aggressive and were willing to get in at any price. In other words, demand has pushed the price up. The sellers were only willing to sell at a higher price. This causes the share to move up. Conversely, if the share closes at the bottom of the range, when I say range, obviously the high-low range, okay, and you're closing near the bottom, this means that sellers were more aggressive and we're just selling to get out of at any price. Excuse me, I didn't get some water. So that's panic selling. And on the other side of the coin, you can say it's panic buying. Get me in at any price, get me out at any price on the selling side. The buyers were only willing to buy at a lower price when the share price is falling. So this obviously causes the share price to move down. When the share closes in a relationship, where the share closes in a relationship, in relation to the range, tells us who's winning the war between the buyers and the sellers. And now we're going to go into more detail in that. So this is what's important. This is the most important thing about candlestick charts. When reading it is who is winning this tug of war. And I want to spend time on that today. Okay. So as a quick, you call it overview, what makes up a candlestick? We can look at what the anatomy of a candlestick. So, for those of you not familiar with the details of candlestick charting, it's important to get the fundamentals, or what I call the basics, right? So the difference between the open and the close is called the real body. And I'm going to bring my cursor in here again. My spotlight. Okay, so this is what they call a real body, and this is what's important also to highlight to you. So if it's white in this example, this means that that's where the market opened and the market closed. That's an up day. If it's colored in, it's black. In our example, it's black. That means the market closed down lower to be down day. So that's an up day. This is a down day. Just at a quick glance, if it's filled in, it's a up day and a down day. Okay, very broadly speaking, but we call this a real body. The higher these values create the upper extremes. Okay, so in this example, we call it, when they say the upper extremes, they either call it the upper shadow. Relating to candlesticks, you can say it's a wick. Okay, but you also get lower shadow, so that's the lower end of the scale. But if you look at a bar chart, that's a high for the day. This will be the low for the day. Exactly what we got here. And same thing when the market's falling down. Where the market is moving down. We've got the high for the day, the low for the day. What's important is the close relative to the open. So you can see the open up higher, but it closed lower, and that's why we have a black day. Okay, so that is the elements of or the anatomy of a candlestick, how it all puts together. But candlesticks are created for any time period, be it monthly, weekly, daily, like we're looking at just now, even go to so far as hourly and minute by minute. Regardless of the time frame, and this is what's important, candlesticks should not be judged in isolation. We'll be talking about it in more detail just now. Remember I said to you, it's the primary, my primary indicator is price action, but you don't just use it in isolation. Traders should always look for the follow-up action. We'll talk about different formations. The follow-up action to confirm any signals during the following applicable period. So following the signal, you want to see confirmation. Okay. Let me just get rid of this quickly again before moving to the next slide. Okay, cool. So my objective today is to look at the candlesticks from a different angle. Understanding the story of price goes further than just checking whether a candle is black and white. Okay, so one of the most important things candles can tell you is whether the buyers or sellers are winning the game. Again, I also want to reiterate that for you. This is the objective of candlesticks. Who is winning this war? Who's winning this game between the buyers and sellers? What's important is, what might be even more important is by how much are the buyers and sellers winning. So to fully understand market sentiment, that's what moves the market up and down. Market sentiment, how people feel about prospects, and you have to analyze 5 scenarios, and they are, if I'm moving to the next slide, these 5 scenarios. Okay, 5 possible scenarios between the buyers and the sellers. Number 1, strong buying power. In other words, buyers in control, demand pushing the price up. That's number 1. Opposite to that would be strong selling power. There's more sellers and buyers pushing the price down. Number 3, sellers tried to force the price down, but buyers managed to conquer, and the price moved up. Alternatively, the buyers tried to force the price up, but sellers managed to conquer. Okay, so there's a little tug-of-war going on all the time. And then lastly, buyers and sellers have equal power. Those are the 5 possible scenarios you always can get when looking at the market. Okay, and again, when you get this presentation, please review it and also go through. I'll send you the PDF also. Review it and go look for these kind of examples. So that's number 1. Number 2 is we've got 5 possible scenarios, but also we've got 5 elements of the candlesticks, and we just touched on it just now. But the 5 elements, number 1 would be the size of that real body. Okay, candlestick formations are made up of 5 scenarios, and any candlestick formation is made up of these 5 by 5 candle elements. So yes, it does look a bit complicated, but just understand it's just 5 things you have to look at. Okay, the length of the wicks, and we'll go into more detail on these just now. But the idea is to combine the 5 elements with these 5 scenarios, and that makes more sense to you. That's what I'm trying to get you today. And then the ratio between the bullish and bearish wicks, that's also important. And then the ratio between the body and the wicks. And lastly, the position of that real body in relationship to the high-low range. Okay, so those are the 5 elements you always have to look at. You got the 5 scenarios and the 5 elements. Okay, I hope that doesn't sound too complicated for you guys. So let's go look at each one of these individually. So first of all, the size of the body. Rule of thumb is that the larger the body, the stronger the signal it provides. Okay, the larger the body, the stronger the signal it provides. A large body indicates that the price has moved a great distance between the open and the close of the candle for that day. A large body and small wicks also indicates some great strength. The larger the body and the smaller the wicks, the greater the strength. Just understand that. So, yeah, you can see the scenario where that's where we've opened and that's where we've closed. In this scenario, big body, but ultimately, you can see there's some shadows, there's some wicks there. Ultimately, the sellers are winning, and vice versa here also. That's where we opened, that's where we closed. Large body, lots of strength, but buyers are winning. Okay, so that introduces what we call, you can classify candles into two categories, what we call wide range candles. That shows high volatility. And in other words, there's a lot of interest in the share. Narrow candles would obviously indicate low volatility and not so much interest in the candles, in the share. Okay, so this just a bit more on that to build up on that. On wide range candles, if we know that shares tend to move in the direction of the wide range candles, we want to follow that momentum. So we look to the left of that chart to gauge the interest of either the buyers or sellers, and then trade in the direction of the trend and the candles. There's the old cliche again, the trend your friend. Okay, until it bends, large candles or large real bodies will indicate the strength, and you want to follow that trend. So the importance of this cannot be overstated. You want to know if there's interest in the share. Is it being accumulated or distributed? Remember, by the institutional traders or the big players in the market. You want to see where are these guys moving the money. Remember, those are the asset managers, the fund managers, etc. So when it comes to narrow candles, okay, narrow candles implying low volatility. This is a period of time where there's little interest in the share, as I mentioned just now. But more importantly, and I find this is where I always focus on, the narrow candles often lead to reversals, either up or down, because low volatility would lead to high volatility, and other way around also, high volatility leads to low volatility. So those narrow range candles, that's it preemptive for me to start looking at the share more closely. So knowing this, doesn't it make sense to enter or buy a share in periods of low volatility, and obviously exit or sell a trade in periods of high volatility? That's what this means by this slide. Okay, so let's move on to the second scenario or second element, and we talk about length of wicks. So length of wicks gives you the direct information about volatility. Okay, the longer candles imply greater volatility, and the long wick and body near the bottom end of the candle shows the momentum has shifted. Okay, so we're shifting momentum. So in this situation, a long wick and body near the other end has shifted momentum. Yeah, we're trying to pull the price down, but we closed up higher. Yeah, we try to push the price up higher, but we closed down lower. Momentum is shifting. Okay, very important. Implies a greater volatility, but momentum is shifting. Let's build on that. On the third element now, we talk about the ratio between the bullish and bearish wicks, or as I mentioned just now, the shadow. So when the price moves up and gets pushed back down, like we saw just now, okay, price try to move up, okay, and the price gets pushed down. This just shows us that the signal that the bullish strength is not enough to keep prices up. Okay, there's not enough to keep it up, and we close near the bottom. Okay, in this scenario here, when the price moves down, okay, and then the buyers come in and push the price up again. Again, you can see both these scenarios there. The sellers are winning, and yeah, the buyers are winning. Okay, so that relationship between the bullish and bearish wicks also important. It tells you where are the buyers and the sellers. Sorry, getting a frog in my throat here. Number 4, let's talk about the relationship between the body and the wicks. If the body is large, okay, and the wicks are small, this tells us first of all that the price has moved from the open to the close without much volatility on either side. But small wicks or large bodies are a sign of strength. Okay, so as I mentioned just now, big move, sign of strength. Big move, sign of strength. Okay, these little wicks on the other side, it's still indicating strength. Okay, if we have long wicks and small bodies, we have indecision. And that's also very important to look at. And that leads me to the last one. When we have the position of the body, right in the middle, like we are seeing here, we have a long body, long shade on top and at the bottom, and with small little body, we're being compressed. The buyers and sellers having a serious tug-of-war, but there's a lot of indecision. Okay, so what's important is that we look at the previous formations before that. Okay, so the main thing here, when you have a small body and long wicks, it's indicating decision. And we'll talk about it more just now. We're talking about some of these patterns and their names now. They be called dojis. But those are the 5 main elements that you need to incorporate when you're looking at these charts day by day. Try and understand who's winning this war between the buyers and the sellers. Try and understand the market psychology. Okay, so let's move into some quick patterns. Let me just see the time. Okay, so the big question always with people is, which candlestick pattern is the most reliable? So that's a big question for a lot of people. Now, we're going to look at 5 candlestick patterns that are time tested, they're easy to spot, and they have a high level of accuracy. Now, price action in candlesticks are powerful trading concept, and even research has confirmed that some candlestick patterns have a high predictive value, some of them as high as 75%. Okay, in other words, you're betting the odds in your favor. I always talk about high probability trading. So these are the candlesticks that will help you bend the odds in your favor. So let's talk about 5 bullish ones. And these are the classic traditional ones. There's over about, I think it's about 48 of them, but I'm going to highlight 5 for you. If you can just focus on these 5, you'll find opportunities. So first of all, when we talk about bullish candles, just understand there are many patterns, but only a few actually worthwhile doing some homework on, and these are the 5 that you want to look at. So we're talking about bullish engulfing patterns. By the way, bullish candlestick patterns are reversal patterns. They show up after a pullback, in other words, a bounce from the bottom of the cycle, we're bouncing up. So this is where these patterns usually appear. So first of all, we have what they call, let me get my little cursor out again, my spotlight, a engulfing pattern. It's a 2 pattern, or two data points pattern. So first of all, it is a favorite for a lot of investors, a lot of traders. Consists of 2 candles, as I mentioned just now. The first day we have a narrow range, okay, and it closes. It's a black day. It closes down, and then the next day we find that we have a wide-ranging candle, and it engulfs or envelops the previous day's trading range. Okay, so it engulfs. That's where the word comes from. It takes, it's big. It's on both sides, engulfs the scenario. So the idea here is that at this point in time, the sellers were in control. Okay, but because of the narrow trading range, remember the volatility slows down, and the volatility is low. Sellers are not so aggressive. Next day, the buyers come in and they're very aggressive. That's where we open and that's where we close. We engulf the previous day. The buyers have overwhelmed. That's another word you can use when you see this kind of pattern. Engulfed or overwhelmed the sellers. In other words, demand is greater than supply. Buyers are ready to take control of the stock, and you can anticipate a nice little run from there. So that's what we call a bullish engulfing pattern. Then we have the hammer. Okay, so the shares opened, and we tried intraday. The sellers tried to push the price down, but ultimately the buyers got control again, and we closed up higher. So it looks like a lollipop, okay, but the real word would be called a hammer. And the easiest way to pick us up at the bottom of the cycle, I always say it's hammering out a bottom. Okay, so at the end of the day, the buyers won, and obviously they had enough strength to close at the higher. So we're hammering out the bottom, the buyers in control. So the reason why these things happen is a lot of times stop losses are being triggered, and that's where the professional traders would come in then and then buy into the stock. But just think about a hammering out the bottom. That's where you see it. So We try to push the price down lower, and ultimately the buyers won again, and we close up higher. Okay, then we get the Rami. Now, Rami is Japanese for pregnant. So again, it's a two candlestick pattern. So the first thing that comes to mind is that the momentum preceding it has slowed down. So momentum, the speed has slowed down. On the first day, we see a wide range candle which closes near the bottom. So it's a black candle, it's a bearish candle, it closes down. This would be the mommy. When I talk about being pregnant, that would be the mommy. And then we have a small, a narrow range candle the next day. This would be the baby. Okay, so it's intraday. Don't get confused between a engulfing pattern. They're nothing to do with each other. Okay, that's a negative day, wide ranging. This is a small baby in between. But just understand that they are total opposites. Okay, but also a bullish pattern. Then we have a piercing pattern. Again, a two candlestick pattern. And what's important, again, wide ranging. Remember, it's very strong. That's where we opened, that's where we closed. But the next day, the buyers came in. Yes, we came in much lower, but by the end of the day, we had enough strength to close up more than halfway into the previous day's candle. That's where we closed. Very, very strong pattern. But it tells you that the buyers are taking control. And then we have the doji. Okay, there's different kind of dojis you get, but you can see by this here, it looks like a cross. Sometimes it's near the bottom, sometimes near the top. But bottom line, the doji represents indecision in the market, as I mentioned just now. So one of the most popular candlestick patterns, the share opens up, goes nowhere, and throughout the day, and then closes at or near its opening range. That's what happens here, and that's why we create a, remember, that's an open, and that's a close. That looks like it's a star. But quite simply, as I say, it represents indecision and causes the traders to question the current trend. And usually, as I say, this will be reversals. They obviously trigger reversals in the opposite direction. Okay, so those are the 5 popular bullish patterns. Let me just go back again here quickly. And then let's look at the opposite now, 5 bearish patterns. And this is where you'll notice that these bearish patterns are the opposite of the bullish patterns. These patterns come after a rally. Obviously, the market's gone to the top and signify a significant or possible reversal, just like the bullish patterns. So now it's your turn. I want to let you look at these patterns yourself and understand the psychology behind it. And the main thing is just to get into your minds who's winning the battle. Okay. So just remember, top of the market, bottom of the market. So in this scenario, we're talking about the top of the market. Understand the psychology. So yeah, the buyers were still in control. Yeah, the sellers were taking over. Yeah, the sellers were trying to push, the buyers were still trying to push the price up higher. The buyers took control and pulled the price down lower. Okay, shooting star always to me it looks like an inverted lollipop, but shooting star, that's a little, it's gone up. Okay, like a shooting star, and then like one of those fireworks things, like one of those rockets, shoots up and then starts falling. And this is what you're seeing right now. Okay, it's losing momentum. Buyers, the sellers are getting control. Arami, this is, remember, pregnant. Top of the market, still open. That's where the buyers are still, that's where we open, that's where we close. The buyers are still in control. Next day, the sellers started coming in. So that's where we opened, and that's where we closed, but it's bearish. Trend reversal down. Dark cloud cover. Okay, we call it just now, we call it piercing. The candlestick charts on the top, we call it dark cloud cover. So when the cloud cover comes in, you know there's rain coming. We need there's could be a reversal. And again, the doji. Okay. So guys, I'm running out of time, but just quickly understand, as I mentioned just now, traders rely on share charts more than any other single type of analysis. With a vast amount of information summarized in a single graphic, share charts can provide insights into everything from long-term trends to short-term trends. What's important, and this one I want to highlight for you guys today, combine these insights with other tools like technical indicators or fundamental ratios to identify promising trades and generate high risk adjusted returns. So there's 10 other things that you want to consider. When you look at these charts, consider other time periods. I looked at the line chart, a daily chart now. Switch over to a weekly chart. Switch over to a monthly chart. That gives you more information about the longer term trends and things like that. And also it helps you also determine the primary cycles, the daily, the secondary, and the daily fluctuations. Okay, but that's number one. Number two, do not ignore volume. Remember, when we talk about technical analysis, two most important factors: price, and we spoke about it now using candlesticks or line charts or bar charts. That's number one, price action. But also very important is volume. The number of shares traded. It's people's commitment to price. Do not ignore it. You want to bring volume into your analysis always. Thirdly, when you're first starting out, use line charts, use bar charts, but then I like to use candlestick charts as my entry level and exit level charts as a default. Always learn the major chart patterns. We discussed 5 just now. As I say, the engulfing, the Ramis and things like that. Those are the chart patterns you want to learn. It's not so much the names that's important. I want you to concentrate on the psychology behind it. Complement price action always with moving averages. In previous webinars, I spoke about using a 50-day and a 200-day moving average. I prefer to use exponential moving averages, but I don't use it so much for timing. It's more for trend analysis, but it's just another tool to help you complement price action. And then number 6, you want to measure the trend strength, and that's where all these other technical indicators will come in, like RSI, stochastic, and things like that. But the momentum indicators will also highlight for you the strength of the trend. Be aware of support and resistance lines, and you'll see on the next slide or the last slide, we are highlighting support and resistance levels. Watch out for market cycles, and then be mindful of gaps. In bar charts, we talk about gaps. On candlestick charts, we talk about windows. Okay. So are the gaps filled? How often they close? And you'll see in the next slide what I mean by that. And lastly, keep on learning about candlestick charts. Okay. And I pick all this information from a website called Trader HQ. There's lots of other information there. Investopedia, a lot of other information, free information on candlesticks. Okay. So just quickly to put it all together, this is the chart called African Rainbow Minerals. You can see I've drawn a long-term support trend line. It's above its 200-day moving average. That's what they call a golden cross. It's hit some resistance. Okay, 1, 2, 3, 4, 5 times. Hit resistance at 137 Rand. It is bullish. That's why I'm still calling it bullish. Yesterday, we had a long down day. Okay, so some profit taking yesterday. It is still overbought, and you can see it's starting to turn. We'll see what happens to this graph. I anticipate it to come back to retest this long-term support trend line. Very reliable trend line, touched at least 5 times. It might come back and test this 50-day moving average, but around about here, anticipate a little bounce. That's all still confirming it. We still up days. And also the volume price trend still confirms price action by volume accumulation. Might have pulled back a bit, but long-term trend is still uppish. Relative strength, relative to the JSE All Share, very strong graph. It shows me market outperforming. And from a fundamental point of view, you're looking at a PE ratio of 5.2 times. So this is a stock that you might want to look at now. Whoops, sorry. That you want to put onto your watch list. But you can see how you put this all together, and what I meant by the previous slide, those 10 things you want to combine together. Okay, so quickly, in summary, we looked at 5 things. 5 times 5 times 5 times 5. We looked at 5 possible scenarios. We looked at the 5 elements. Again, the size of the body, the length of the wicks, the ratio between bullish and bearish wicks, the ratio between the body and wicks, and the position of the body. Those are the 5 elements. Then we looked at 5 bullish candles and 5 bearish candles. Okay, so hopefully I've shed some light on candlesticks for you today, and just understand it's a very powerful tool to help you understand market psychology. Okay, so guys, from my side, I hope you've enjoyed this presentation. It was beneficial to you. Just in closing, I said I'll be sending you the webinar recording as well as the presentation PDF. It will, as I say, hopefully be emailed by tomorrow. Play with candlestick charts. A lot of people get intimidated and say it's for advanced trading. No. Understand it right from the beginning. Just understand the psychology. Zoom in and try and understand it from there, what's happening. Okay. And then open up a share trading account with us today if you don't have an account, and then apply what you're learning and in your trading. Then lastly, if you don't have a share trading account, you can get some more information on our website. You can also contact us on the email as well as phoning us. But from my side, guys, thank you very much. There's my contact details. Let me see what kind of questions you guys have here. Gerard needs a 2-hour session just on this. Morris, great. Okay. Guys, I see some of the questions here that the slides weren't changing. Is that true? Did you guys see the slides? Wasn't aware of that. Thanks. Cool. Okay. Will these slides be loaded on the website? Okay. So the thing here from Gerard. Thanks, Gerard. It changed rather slowly. So this is what happens when I'm using Wi-Fi instead of the network cable. Rasdeen, thank you. I hope you say it's excellent information. Great. Hopefully I got my point across to you guys. The psychology behind it and the importance of candlestick charts. Okay. Okay. Great. Thanks, Lorraine. Pleasure. Okay. Yeah, to answer your question there, this presentation will be available on our webinar archive, but I'll be emailing it to you anyway. Okay, so you can go through it. Any questions you guys have from the presentation afterwards, please, you're welcome to contact me. Okay, looks like that's it. Guys, as I say, from my side, thank you very much for attending. I think this will be our last webinar for the year. We might see if there's something else, maybe December, but most people are basically winding down for the year already. Okay.